All right, hey, welcome to River Crest Apartments. My name is Tyler Devereaux. I'm the managing partner of Multifamily Capital Partners. I'm also the lead sponsor of this investment. I'm going to be the one walking you through everything today, okay? I'm going to give you a quick overview to kind of help outline the investment, and then I'll dive into the rest, okay? I'm going to quickly show you the exterior first, then we'll dive in, okay? All right, there we go from the exterior level, okay? And listen, first, if you don't like those Halloween decorations, we have to officially uninvite you from participating, okay? Now, seriously, we are, on a serious note, we are excited and just grateful, to be in a position to bring you the investment. We have been lucky enough to create an amazing foothold in the Columbia market at a very opportune time, which is allowing us to be on the right side of a market correction, and you'll see that. River Crest is a prime example of that, right? Which is why we're so grateful to be in a position to present it to you and have you on board. So this deal doesn't happen without that foothold, by the way. We have awesome broker relationships in the area. One of those relationships was actually jeopardized recently due to a deal falling out of contract. Because of that, though, our broker wanted to find a way to make it up to us, okay? And that was from a tough seller that he was working with, which essentially, insert River Crest, this is how they make it up to us. We'll obviously get into more details, but this is one of, if not the best cash flowing properties right out of the gates that, now we've seen in a long time, which is exciting, okay? Which is exciting. The property also is located in an awesome area, okay? It's at the end of a cul-de-sac that has a business, it's like a business park in front of it. It's surrounded by thick green pine trees, almost said palm trees. And it's surrounded by retail too, has easy access to the internet, interstate, and the internet actually, and 10 minutes from downtown, okay? Quickly, some legal stuff, okay? Legal stuff that I have to go through. What we're about to go through is not an offering. The official offering will be done through the private placement memorandum. That will outline all the risks in terms of the deal. This presentation is for informational purposes only. It's not intended to be a general solicitation. By accepting the presentation, this is always the worst part to go through. I can't remember exactly what to say, but by accepting the presentation, you agree to keep the information confidential merely as a way to evaluate a business relationship with us. Also, forward-looking statements, okay? All the returns, like the ones we're just about to discuss, are forward-looking statements, right? And as much as I would love to be able to predict the future, haven't quite figured that out yet. I'll keep you posted. But that being said, all forward-looking statements are based on, our projections of the market, the asset itself, and from the experience with other properties in the exact same market. But as with everything, though, okay, this investment is subject to, uncertainties that could cause the actual results to vary. Okay, the private placement memorandum, the PPM, will outline a number of the risk factors for you to consider, though. Okay, we can skip through the table of contents. We'll dive right into the investment highlights. I'm going to give you a high-level overview of the investment, then we'll dive into some of the nitty-gritty details, and then we'll dive in from there to the next steps, okay? So, River Crest Apartments, okay? River Crest Apartments, 150-unit apartment building. It has a garden-style townhome floor plan layout, located 6 miles northwest of downtown, northwest Columbia. That area is seeing so much growth. The property's 90s vintage. It was built in 1994. Has an awesome unit mix too. 3-bedroom, 2-bath units, 94% of which have townhome floor plans. Very rare in the market, which is awesome. In fact, we actually own another apartment just down the road from here, which only has 1- and 2-bedroom units. And we get people there regularly, primarily families, requesting 3-bedroom apartments. And now instead of turning them away, we could refer them up to River Crest, which is fun. Which means, in other words, okay, we're creating slowly but surely a monopoly in the Columbia market. We're excited to have you on board for that. Now, I can't remember if I mentioned this or not, but this is a true off-market deal. And to clarify why that's so attractive, the majority of the time, when we compete, when we're buying a property, we compete against a number of other buyers, okay? And when that happens, that inevitably drives the price up and forces us to walk away on a regular basis. But because this was an off-market deal, we were able to avoid that process. Our broker actually found and sourced the deal directly from the seller and then brought it directly to us. We were literally the only ones, the only people, the only group to see the deal, which is fun, which allowed us to ultimately negotiate a purchase price of $10.3 million, which is well below market value. You'll see that. In fact, we didn't even bother with an LOI. We just went straight into contract negotiations. First time I've been able to do that. It's fun. And because of that, investors will be able to choose a preferred return of either 7 or 8%, depending on the investment amount. I'll explain that as well. And then projected annualized returns in the 18 to 19% range. You'll receive those returns through a combination of cash flow and equity. Okay, so cash flow throughout the hold period, equity once we sell, and then preferred return just means you get paid first, as you should. Okay, we're going to be raising $5 million for the project, a total of $5 million. As sponsors, we're going to be personally guaranteeing the loan, and we plan to cover approximately 5% of the equity for the project as well, which means our capital is invested right alongside your capital. We think that's important, and you probably do too. Okay, this offering is for accredited and sophisticated investors only with a minimum investment of $100,000. The preferred return will be 7 or 8%, as mentioned, depending on the investment amount. So those that choose, exit out of this for you. Those that choose to invest over $150,000 will receive an 8% preferred return, but that is capped out at $2.5 million, by the way. And then funds will be due by November 20th. Here we go, November 20th. But the availability of shares, I just want to make this clear, is on a first-come, first-served basis on all share types. So those wishing to invest less than $100,000, you can request to be placed on a waiting list. And what we'll do is we'll notify you if, as smaller gaps that need to be filled come in. If those positions arise, though, they will be on a first-come, first-served basis. All of our shares will be determined that way. And then distributions will be sent quarterly. And because this property is cash flow positive on day one, that first distribution will be sent out the first quarter after closing, which is great. Now, to get an understanding of the value, or at least the potential value, okay, and an understanding of it, we can look at some comparables in the market. So we own a little over 800 units in the Columbia MSA. So we look at these comparables on a monthly basis at least. And for sales comps, we look at 4 qualifiers. Okay, they have to be built between 1980 and 2000, obviously within the Columbia MSA, typically within a 5-mile radius, that have sold within the past 12 months and are over 100 units. And there were 4 multifamily assets that fit that criteria. Average year built was 1987. The average number of units was 238. Average cost per door, $92,000 per door, and then average sales date of April 2020. We are picking River Crest up, which was built in 1994, for $68,000 a door, which is a difference of $23,000 something per door, which equates to a price difference of $3.5 million. And listen, when I first saw that, I was a little skeptical, right? I understand that the average sales date is April 2020, but let's be honest, man, a lot has happened and changed since April. Here's what's crazy though, if you take comparables from those that have sold over the last 4 months, the average price jumps to over $100,000 per door, which is obviously why we decided to show y'all comps from the last 12 months instead of 4, because man, we have to try to keep y'all's expectations in check, okay? Long story short though, we love the direction, man, that the Columbia MSA is headed. And I'll explain that in more detail shortly as well. I'll also explain, because I want to make this clear, I'll also explain why the property is being sold for so far underneath market value. Yes, we negotiated a good deal, but the best negotiating tactics are the ones that actually have logic behind them. Meaning that there's a reason it's being sold for less. And there is, and I'll circle back, to what that is shortly as well. And I lead with all that for a reason. Listen, and I do so right out of the gates because there is such a divide right now, that's common though, right? That's common in any sort of a correction. And, some are certain about investing. In fact, I would even say excited to invest right now because of the correction. Others are uncertain, maybe even fearful about investing right now because of the same thing, a correction. But here's what's crazy, or interesting maybe, right? The seller is exiting the property for a couple of reasons, but primarily those reasons are fear and uncertainty. Why? Because with a correction comes risk, and they are not seasoned enough to feel confident in mitigating that risk. You'll see that their operational strategies and procedures are not great. They've owned the property for 5 years, have naturally benefited from an economic upswing, and they're terrified about losing what they've gained, which is exactly why we're buying it. A year ago, this deal doesn't exist, for sure, because sellers were overconfident. I'm not certain about very much, okay, but I am very certain that the time to buy is when sellers are uncertain. We understand that there's risks. There are risks with any investment in any environment, but you'll also understand and see that we understand how to mitigate those risks. And one way to mitigate the risk is to understand market trends, to understand where you were at and what is happening in the market. So let's talk about that. The Columbia MSA and South Carolina as a whole, we love how it's trending, and it's one of the highlights of the deal. Okay, for reference, there are 4 major influencers that shape what people buy and where they live. Okay, government, the economy, technology, and societal shifts. They change, they'll change the future just like they changed the past. Okay, so with that in mind, to give you some examples here, as we look at those 4 characteristics, those 4 market differentiators, as it refers or as it relates to Columbia and South Carolina, government-wise, South Carolina ranks second in the nation in terms of having a cooperative and responsive government, which eases location and expansion processes for businesses. They also rank 4th in the nation in regards to regulations favorable to companies, by the way. The economy, South Carolina ranks 16th in the nation for its strong business climate. Columbia ranks as the 14th strongest metro. There we go. And that has been shown as they've been in the top 25 in the country for job creation since May. And then technology. So University of South Carolina is home to a 40,000 square foot incubator that houses 45 young companies, making them the top 3 tech incubators in the country, which obviously bodes very well for growth, future growth. It's already having an impact. And then societal shifts. Okay, those born from 1989 to 1993 constitute the largest 5-year age gap in the country. Those 27 to 31-year-olds have been slow to form households, but they will lead the addition of nearly 6 million households by 2025, meaning they're finally going to move away from home. Columbia ranks number 2 in the nation for millennial cities, with an average age of 28.3 years old, which is great. Okay. From there, a quick snapshot of the return breakdown, okay? This diagram shows you the breakdown for each $100,000 that is invested. So for each $100,000 that is invested, what the cash flow and returns will look like. So cash flow returns of $35,000 plus equity returns of $55,874 plus your initial investment of, let's say, $100,000 equals $198,74, which equates to a cumulative return of 90.87. Like I mentioned earlier, though, as well, those investing $150,000, over $150,000, will receive an 8% preferred return, which will take these returns even higher. But I do want to quickly touch on return projections. Okay, those of you who have been investing with us for a while know that we don't take return projections lightly. Projections are awesome. Optimism is great too, right? We should have more of that, I'm sure. But there are a lot of things that can wipe out initial return projections as well as the initial optimism that comes with it. We are acutely aware of that, okay? And I want to make that clear, which is why, though we're very optimistic, we are still very conservative, very conservative. In fact, the cash flow returns is an example, is a great example of this, okay? If you look at the cash flow returns, this property is already cash flow positive and will get, be even better as we continue to implement the business plan. But we don't account for an increase within our cash flow projections the entire way through, only the base preferred return. Because as you know in life, things do not always go as planned. So as great as the property and the area are, in my opinion, they should never be, the deciding factor for this investment or for any investment. The largest factors behind deal performance are the operators behind it. That is a lot of responsibility, right? You take your eye off the ball, and even the best assets in the best markets will underperform. On the other hand, a solid operator can cause almost any investment to meet or exceed projections. So, yeah, we're careful with projections, but I also want to make this clear. You'll never see us or hear us shy away from those projections either, COVID-19 or not, because we know what it takes to get there, and we're dedicated to getting there. Now, for example, we get paid a fee up front to guarantee the loan and to structure the deal. Right? This is standard on every deal, every deal that we've ever done. And typically, we cash that out when we close. But instead of cashing that acquisition fee up front like usual, a portion of it will be held in an escrow account as a reserve. Okay, that means if we fall short of projections, that acquisition fee will be used to supplement your cash flow returns. But then, however, right, when we hit our return projections, the property will pay for your cash flow returns, which means then we would be able to cash out our acquisition fee. Why would we do that? Because we know what it takes and we're dedicated to getting there. Plus, for hell's sakes, we totally, lowball the returns to make sure that we'll get there. On a serious note, though, we know what it takes to get there, and so we're more than willing to do that. We know that we won't need that reserve, but you don't. That's a way for us to show you that we know that, okay? So as a partnership, we own a little over 2,600 units. 868 of those are in the Columbia MSA. Those 2,600 units and who knows how many years of experience do not come without mistakes. Now, once again, those of you investing with us for a long time can attest to that, okay? But what we have learned from those, man, it's what makes us so valuable as a partnership. And I know you can attest for that as well. Those mistakes are another reason why we're so confident in our ability to meet and exceed returns. I mentioned, right, that in real life, things just don't ever go as planned. Now, the initial plan is important, okay? But that isn't what exceeding return projections come down to. Executing the business plan and exceeding return projections are in direct correlation with the operator's ability and willingness to solve problems. Outside circumstances will inevitably affect the path, right? But our job as operators is to make sure that they do not affect the destination. So first, thank you for sticking with us through the learning lessons, and continually trusting us with your investment capital. There is zero way that we would have been able to acquire $170 million worth of real estate without you. And you have played a role in almost every single one of those acquisitions. And those past investments that we've done together play a big role in, continually having opportunities like River Crest presented to us. So I want to say this, regardless of whether you're joining us on this investment or not, sincerely as I can say it, thank you so much. And those of you who will be investing with us for the first time, we're excited to have you on board, okay? It's about damn time, by the way. Let's dive into some of this as well. All of you know who we are, at some level. One of us or all of us somehow. But we have included a more detailed write-up about each of us for you on pages, I think it's 48 and 51 of the property packet. As per usual, though, feel free to reach out, if you have any additional questions about us or the investment. Our contact information can be found on, I think it's page 55 at the end, okay? But a high-level overview. Okay, we have Greg and Lisa Parrish. They are, and their sons, Adam and Eric, okay? They make up GLP Investments. And they have a home in North Carolina as well as here in Columbia, and they split their time between the two. And they are, in my opinion, the primary reason you invest in this property. They are the founders of Omni Management Group, have 11 years of property management experience, which makes them just a wealth of knowledge. They will be at the property regularly to oversee capital improvements and operations. You also have Ryan Woolley and myself. We are the managing partners of Multifamily Capital Partners. We'll act as the lead sponsors for the project. We'll also be in charge of overseeing investor relations, business operations, as well as financial asset management. And then we also have Sarah Sullivan. So Sarah Sullivan is the founder and owner of Sugo Capital, as well as the host of the Confident Investor Series and the Women's Wealth Show. She is also the Director of Engineering and Customer Success at a startup in Silicon Valley. She's a wealth of knowledge as well, man. She'll assist in investor relations, business operations. She has just a brilliant operational mind. And then all of us will participate in due diligence and acquisitions, amongst other things, okay? All right, here's a quick snapshot of our track record, which is also outlined, by the way, in more detail on pages 43 through 49 of the property packet. But we've taken 6 properties full cycle, with the 7th under contract scheduled to close. It's mid-November is when that is. Our average cash-on-cash return to investors is 9.7, which exceeds, by the way, our average projection, which is of 7.85. Our average annualized rate of return, also known as ARR, is a whopping 77.28%. But, okay, I always have to clarify though, that is, and I have this on here too, bullet pointed, but that is inflated by a property called River Crest, which is the property Greg and Lisa used creative financing on. Long story short, they turned $45,000 into $800,000. And I do not want any of you to have that expectation, okay? And so if you take that property out, our average annualized rate of return amongst our other assets is 34.3%, which far exceeds our average projection of 22.71. And that equates to $9.6 million of equity that's been created on projects that we've taken full cycle. Now, with current assets that we currently have under management, okay? We have, current assets under management values just under $150 million. We have an average occupancy right now portfolio-wide of 94.25%, with just under $19 million of equity created on those projects. All right, then we've leveraged that track record with our lending connections to source a new Freddie Mac loan. Has a 7-year term, 3 years interest-only period, and a fixed rate of 3.6%. That is the lowest interest rate out of any of our properties. That just provides a lot of long-term upside on this deal, which is fun. And the hold time will be approximately 5 to 7 years. And I'll walk you through the strategy, what our strategy will be during that hold time. Okay, those are the highlights. Okay, now let's get into more of the details about the project and the business plan. So this gives you an idea of the geographical layout. It's a map of the area. The property's right up here up top. River Crest location is one of the highlights for sure. We're surrounded, and I think I mentioned this too, but it's located in the northwest side of Columbia. That area is seeing just a ton of growth. Properties being rehabbed, built, all sorts of stuff. We have retail, restaurants, and other conveniences right by the property as well. Then we have Costco, Publix, Foodland, Walmart. They're right down the road. We're 4 minutes from Fortis College. It's on there somewhere. That's a college for nursing, dental, and healthcare programs. We're less than 10 minutes from University of South Carolina, downtown Columbia, Lexington Medical Hospital. Lexington as a whole is just a great area. It has some of the best schools in all of South Carolina, and then Columbia High School is right next door to our property as well. We're down the street from car dealerships, hotels, convention centers. We're not far from Riverbank Zoo and Gardens, which is one of the top tourist attractions in all of Columbia. Great location. It's also located, it kind of sits in the corner here, right, of I-20 and Interstate 126. both of those provide quick access to all the other major interstates, which allows you to get anywhere throughout Columbia very quick. Zooming in will give you a better idea of like the parcel layout. Okay, we have the property sits at the end of a cul-de-sac. There's a business center on the other end. I think I mentioned that. The pool, leasing office are right up front, which is a plus, but they're not even using the leasing office. It is outdated to the point that it's not even in use, which I can't quite wrap my head around. The gym isn't in use either. They have a nice playground and dog park that tenants seem to love. As a whole, the property really has been kept pretty clean, but man, a few minor landscaping touch-ups as well as upgrades and additions to current amenities will make a world of difference on the property for sure. So we're going to be rebranding, by the way. The property is currently called Park at River Crest. We'll be rebranding to River Crest Apartments. So we'll update and enhance signage. And their current sign looks good enough, but in the pictures, but the location, the angle, the design, it makes it very easy to miss. So we'll switch that up. Obviously, the first matter of business will be to rehab and remodel the leasing office, okay? And I know this sounds crazy, but we're actually going to use it. And call me optimistic, okay? But I would imagine that will help with occupancy and rent increases as well. We'll also add some security features like a gate and some security cameras as well. This complex is off a main road, but it's also kind of hidden. That's a great thing, but as long as you have security cameras, like we mentioned. Tenants also love having a gated community. And then lastly, we'll upgrade current amenities and add some other amenities. I'll explain this shortly, but there's huge value in this approach, specifically in this area. I mentioned that earlier that there was a reason that we were able to negotiate the price that we did. The primary reason I would say is that we're picking the property up for so far under market value is, I would say, twofold: outdated interiors and lack of usable amenities. They currently have two interior types, okay? Classic and renovated. Classic includes pretty much everything that's outdated, okay? Original carpets, old cabinets, tan and white appliances, as well as dated lighting and plumbing fixtures. Renovated units include new items that pretty much look outdated. Marble-looking countertops, those aren't horrible, those are pretty decent. Black and stainless steel appliances, which are typically in classic units. Dated lighting, dated wood cabinets. Some have some wood plank flooring. That's okay, but many still have just old, gross carpet. The model unit, by the way, I'll mention this. The model unit that they have been using is rough. We couldn't believe it when we saw it. We're talking old, gross, carpet, dated wood cabinets, less than attractive light fixtures. Once again, that's such an easy fix that will pay huge dividends. The purpose of a model unit is to upsell tenants into a premium unit because those come with premium rents, right? Which increase the value, cash flow, everything. I'll explain the takeover strategy shortly, but in short, okay, when a tenant chooses to vacate, we're going to turn those units into a premium product, which will allow us to bring in a new tenant and immediately bring rents up to market rates. So renovating the model unit and the leasing office alone will provide huge value in our ability to do that. Now, and then, like I said, they do have some renovated units, but honestly, the market would still view those as classic. These are the things that we'll add in our updated premium units to help with that. Okay, the unit mix. The property's made up of 8 3-bedroom, 2-bath units, 141 3-bedroom, 2.5-bath units. They're the townhome style apartments. Like I mentioned earlier too, the 3-bedroom townhome floor plans are very rare in the area. 3-bedroom units also attract a great tenant. One who usually stays longer, is more qualified. Those units are also easier to rent at any stage of the market. The 3-bedroom, 2-bath units are 1,106 square feet, have an average rent of $728. The remaining 142 units are 1,196 square feet and rent for $884. and are almost 1,200 square feet. I can't remember if I mentioned that or not. All right, high expenses. Okay, I'm going to tell you this. High expenses, poor operations, and below market rents are the major drivers of this deal. Okay, the property is currently being ran at an expense ratio that is 12% above market average. That's due to extremely high payroll costs and above average turnover. Our management company, Omni Management Group, will take over immediately after closing and begin to implement operational systems that will reduce turnover, alleviate the crazy payroll costs, and ultimately bring the expense ratio down to normal. For reference, okay, just that one thing, bringing expense ratio down to normal, in line with market average, would result in adding nearly $83,000 of income to the bottom line, which increases the overall value of the property by over 7 figures. They have maintained 95% occupancy, but that has been done through low rents and really market demand alone. I shouldn't say that. They actually do have a pretty good reputation, and that certainly helps. They're just not the best operators. I mentioned that they are selling due to fear and scarcity. Well, they haven't raised rents for the exact same reasons, fear and scarcity. And anytime that you operate in fear and scarcity, you are by default limiting your potential. This applies to all areas of life, okay, including apartment value potential. 70-something% of the units still need to be updated for reference. And upgraded units in this area rent for at least $125 more per month. That equates to a loss of like $196,000 of yearly income. So, we project that upgrading the curb appeal, property amenities, unit interiors, along with obviously improving business operations, will result in over $6 million of equity in the next 5 years. So much value potential in this deal. The takeover process. Okay, the number one reason people leave is maintenance requests not being handled. Either they're not being done or they're not being done properly. So the number one reason people decide to renew is the opposite of that. Okay, it's a sense of community. It has very, very little to do with rents. In fact, people, especially in this quarantine type of environment, we found have had this need for a connection, and they want to know that you care, which means each phase of the takeover process is designed with that in mind. The focus is to build relationships, to remove tenant concerns and really begin to build momentum on the property. And that all starts in phase one. First thing we do in phase one is we reach out individually to each tenant to inform them of new management. The goal of that is threefold. Okay, 1, to start building relationships. 2, to put a plan in place for any outstanding maintenance requests that they may have. And then 3, to start setting proper expectations in regards to our operating procedures. Phase 1 also includes exterior improvements, telling them that we're different and that we care. That's one thing, right? But momentum truly starts when they start seeing the changes that show that we care. And then phase 2 will be centered around keeping the momentum that we've gained and mitigating risk. We'll do that by evicting slow and non-paying or troubled tenants. It begins to set proper expectations and keeps positive momentum on the property. We then contact any tenant with a lease expiring in the next 90 days. This allows us to get a pulse on upcoming turnover, which allows us to spread out lease expirations, but also start to renew rents, leases at the increased rents. But it also allows us to plan for make-readies, okay, which takes our turn time and reduces our turn time, which allows us to capture market rents from new tenants. Which is great, lowers expenses, increases income. And then phase 3 is where the bulk of the capital improvements start to happen, both interior and exterior. Some of those will be happening simultaneously, within the other phases, but the bulk happen in phase 3. All right, those capital improvements are broken down into detail here, okay? We've accounted for a little over $1.1 million of capital improvements, the bulk of which will be used for unit interiors like you'll see. That being said, though, we bid out every project. I want to make this clear. We bid out every project. And a lot of those projects we bring in-house. So we hope to come in under budget on a lot of those. When we do come in under budget, okay, those extra funds that we save then go into a reserve account and are distributed to investors when when it's appropriate. I would say that this is one of the major reasons that Greg and Lisa are so extremely valuable. They are some of the cheapest people I've ever met, and I say that in the best way possible, right? That's exactly what you want in asset managers there. They also have a teenager who they work very hard and hardly pay. Best parents and partners ever, okay? All right, now to the important stuff, right? Your return summary. Let's dive into the details of your return summary. This breakdown, slide 27, shows how the $5 million in equity will be utilized for the property. The down payment is 27%, by the way, which keeps the property very leveraged. Just over 1.1 I mentioned will be used for capital improvements. I just outlined that, but it's split into two areas here, okay? You have $704,000 for capital improvements, then you have $409,206 under capital reserves. Freddie Mac is requiring a 1-year principal and interest in a reserve account with them. It's very common with any new loan. We won't need to use those funds in year one, but they'll be released after year one, and then what we'll do is we'll use those for additional interior upgrades at that point. The acquisition fee, loan guarantor fee, $618,000. Like I mentioned, a good chunk of that will be placed into another reserve account, and that will be paid out only if we hit our return projections to you. On that note, though, too, we would rather invest in the property than cash it out anyway. So ultimately, that will just add to our equity contribution and go back into the property. Then we have closing costs, $206,000 in closing costs. 1% for loan points, which is $75,000. We keep a property tax reserve as well, $68,000. That's a grand total of $5 million for our raise there, okay? Now this breakdown shows a side-by-side of the financials. Okay, the left represents the numbers at takeover. The ones on the right are the projected year one numbers. We'll increase the NOI by $134,100 in year one. And we'll do that by executing the takeover plan that I just outlined, which will reduce vacancy and turn times, allowing us to turn about 30% of the units to a premium product in year one and bring those rents to market rates, which is huge. This slide here is a lot of detail here, okay? It's a 5-year pro forma breakdown. A couple things to note as you go back and look at the numbers later. Rent growth. Okay, we are currently 11% below market rents, but we've been extremely conservative with our rent projections. Year one is like 6%, years 2 and 3, 7%, with years 4 and 5 around 5 and 4%. We keep vacancy at 5% each year. Concessions, these are these line items here. Concessions, we've accounted for 0.5% in concessions for the first year, 0 for years 2 and 5. Bad debt is estimated at 3% per year. And then 2% for the second year, and then 1% after. Bad debt, by the way, is a receivable that's no longer a collectible, such as rents that weren't paid. Non-revenue units, okay, these are things like model units, okay, non-revenue producing units such as a model. We account for that here, not in vacancy. We only plan to use model units, by the way, in the first 2 years as we're converting those to a premium product. Then after that phase is complete, we'll begin to rent it out, which will reduce this loss and then add rental income instead. Then we've accounted for 5% increase for property taxes each year. And then every other line item here, we've found that a 2% increase gives us enough of a buffer to keep us in line with projections. The only line item that doesn't increase by 2% each year is management and asset management fees. Those are fixed fees. Payroll down here as well. We have full-time staff on the property, which is a line item obviously that we account for. I think I mentioned that they have crazy payroll costs. We'll reduce those for sure. And then you have a lender requirement of $350 a door. That doesn't increase either. We're going to use those capital expenditures for the property, when things arise, like I mentioned earlier. But once again, we're also required to have a pretty good chunk with the lender as well, so we'll be good to go there. And then debt service is also fixed, but you'll see that it's fixed for the first 3 years, and then it jumps after year 3 to $400,000. That's after the interest-only period expires. which then brings our total cash flow before taxes to 386 something thousand at the end of year one. Okay, this breakdown is the return of net projections on the project. Once again, 35% cash flow returns. Investors will receive a 7 or 8% preferred return. Those returns are backed by the acquisition fee and the escrow account, like I mentioned. From there, equity partners will receive 70% of the cash flow on the project. But if those returns do not hit the 7 or 8% preferred return thresholds, we'll actually increase that number. So you'll continue to get more and more until you at least hit that. So total returns from cash flow, 35%. Now, once again, we're very conservative with our cash flow returns. Haven't based our projections off anything higher than the pref. But this property is cash flow positive out the gates and will only get better, okay? The returns from equity, 55.87% for a total return, cumulative return over a 5-year hold of 90.87%, 18.17% annually. Once again, though, those investing over $150,000, your returns will be more because your preferred return is higher. The middle graph here shows a more detailed look at the equity breakdown. So we account for a 5% sales expense, 1% disposition fee that goes to us as operators. And then according to projections, once we've covered the loan amount, loan repayment of like $7.5 million, paid back your initial equity investments of $5 million, we'll have created just under $4 million in equity on the project. Very conservative number. And 2.79 will be split amongst investors at that point. And then total project cash flow comes in at 1.875. The only return metric that I haven't shown you yet is IRR. That's calculated down here at the bottom, which will be 16.2% on a 5-year hold. Okay, let's dive into the market stats. The Columbia market, Columbia, South Carolina market hits all of our major indicators, which is one of the major reasons we're so committed to the market. Those indicators that we look at job growth, we look at job diversity, household formations, populations. Okay, so let me get into some more details here. South Carolina, I'll just rattle here. South Carolina consistently ranks in the top 5 for most business-friendly states in the nation, most productive states in the nation. South Carolina is super committed to just providing a healthy business environment. They lead the nation, I think, in business incentive programs. They have an attractive corporate tax environment. They maintain a very low competitive labor environment as well. That's due to having the lowest unionized labor rates in the entire country. They also have a very strong collegiate system, which produces a high volume of hard-working individuals each year. Also, South Carolina has industrial power rates that are 9% lower than those in other states. Listen, all of those things play a major role in the overall cost of doing business, is my point, which is something that you better believe that businesses are looking at right now. South Carolina also boasts living costs that are 12% below national average. You add a lot of sunshine, and you understand why growth continues to flow south. In fact, economists predict that southern regions, where roughly 42% of Americans currently live, will welcome 62% of U.S. household growth over the next 5 years. We love Columbia, love South Carolina. That growth has already started, to happen in Columbia. Their population has grown nearly 12% over the last 10 years, almost twice that of the national average. The city is also home to Fort Jackson. So Fort Jackson is the U.S. Army's main production center for basic combat training. It's home to 36,000 troops, 46,000 retirees and their families, and the training grounds for 60% of the women entering armed forces. It's awesome. Also, Columbia's ideal location has made them a transportation hub. So the metro is served by 2 major airports and 2 major rail lines. Columbia is also located in what's called the Midlands Highway Network. That's I-20, 26, and 77, I think. but it gives it direct access to 3 major interstates, indirect access to 2 more. The only city in the southeastern U.S. with that type of access, which is awesome. Also, you have quick access to Charleston, Charlotte, Greenville. You're 3.5 hours from Atlanta and Raleigh, halfway between New York and Miami. It makes the city's location and infrastructure just this prime target for growth. Once again, checking off, our major indicators: job growth, job diversity, household formations, population. So to give you some stats there, the household formations it's a direct stat that we look at, right? That's demand for our product. It's increased by 2.23% over the past 12 months. Our qualifier is 2%. Household growth is actually projected to increase by 3.2% over the next 5 years. Population has also swelled by over 12% in the past 10 years. Our qualifier for that is growth over the past 3 years, as well as projected growth. Employment growth has increased by 3% over the past 12 months. That took a hit in April, right? But they have consistently ranked in the top 25 for positive employment changes since May. And then lastly, 50% of U.S. renters are age 30. And the median age, right, for Columbia is 28.3. Another reason why the rental market is so strong here. All right, market comparables. We always do a market survey of our competition, right? We do that. It's really a threefold approach, okay? We do that by calling them, or actually visiting the property and posing as potential tenants, or calling them and visiting the property and just interviewing the property manager on site, just telling them exactly who we are, what we're doing. We've found that to be the most effective. And then lastly, we have our property management company do the exact same thing. We've found that that's really the only way to get up-to-date, correct information to determine what our true loss to lease on the property is. And then what we do is we choose our competition based on asset vintage and grade, proximity to the property, comparable amenities, unit size. So for example, Glen Eagle, as well as Landmark, are very comparable to River Crest. In fact, Glen Eagle is 1.9 million miles down the road, not million, miles down the road. Landmark is 2.1 miles down the road. And this gives you an idea of how far below market rents we are at River Crest. I mean, as much as $220 below. Now, we did the math on what that breaks down to. Okay, this is going to start to, it opens your eyes a little bit. We're as much as $222 under market rents. So if we captured 2/3 of that, okay, 2/3 of that would equate to $148 on average. 150 units times 148 totals a monthly loss to lease of $22,200 and an annualized loss to lease of $266,400. Putting it, that's how much rent is being lost, income is being lost on the property each and every year. That equates to over $5 million of value. And how you get that number, you take the annual loss to lease of $266,000, you divide it by the market cap rate of 5.18%, and that gives you the additional value on the property, which just goes to show, guys, it's obviously huge. You know, it once again shows how conservative the projections are and the different ways that there are for us to realize those gains. It's exciting. Once again, a foothold in the market right now on the right side of a market correction. And then lastly, here's a breakdown of the sales comparables on page 39 if you want to take a deeper look at those, okay? All right, and then finally the next steps, okay, as you look to dive into the investment. And I know y'all, I don't know if you see this guy diving in behind there though, but I know you love that video in the background. I know you do, okay? So after you've reviewed everything, and first off, if you haven't reviewed everything, I don't know, okay, maybe you skipped right to the end of the video, I don't know, but if you did, okay, go back and rewatch. It was fantastic, okay? Be better. But once you're ready, you should see an Invest Now button that looks something like that in the top right corner of your data room. That's where you review all the offering, essentially, and all the related subscription docs along with it. Then, once you've reviewed everything, it's a fit, you'll be able to sign the investor docs electronically, after which we'll send you wire instructions so that you can reserve your spot in the investment. We're excited to have you on board. All right, now just a quick review of the critical dates and investment minimums. So investments will be due by November 20th, right? But please remember to those funds or those shares are on a available at a first come first served basis. So feel free to reach out to any of us if you have some more questions or details about any of that stuff. And then distributions will happen quarterly. Once again, with the first distribution to go out the first quarter after close. Next steps from there as well. Lastly, essentially our contact info. Okay, as per usual, feel free to reach out if you have any questions about what we've just went through, the return, the investment, anything. Okay, we're an open door, more than willing to help you with anything that we can in any way that we can. My voice is starting to go. So first off, thank you for making it this far with me. Y'all are amazing. Take care. Looking forward to having you on board, okay? Aloha.